welcome to Market Domination. I'm Julie Hyman, Alexandra Canal in for Josh Lipton today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The big story here is the PE multiple is very high at Walmart. It's 38 times versus the 3-year average of 24 times. So the expectations have been very high as the stock's really worked well. What's really happening is the guidance, and people are responding to the guidance. The guidance is a little softer than street expectations. However, we're encouraged that this is conservative and in line with the past in terms of how Walmart guides, and this was a solid quarter.
Split, no split, it's you never know what happens there. I would just tell you from the record gains or the continued growth in the stock, and obviously it's pulled off a little bit last few days. You don't have to look any further than the results and also where they're investing. And they're investing in significant hardware, software improvements, given all the opportunities within AI. And frankly, they're one of the few companies where we're seeing these investments turn into revenues.
AI is going to help their core business. They're using it for their advertising, for their e-commerce and all that. So I think it's a natural partnership there. So I think that's the key thing. And it's going to help every other company, Facebook and Amazon, to really enhance their product line, their productivity, their effectiveness. So AI is going to help across the board for many companies because of the way it is.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We've got a sell-off going on, pulled lower in part by Walmart and the sort of concerns it's sparking about consumer spending. We've got the Dow off by 519 points or so, more than a percent. The S&P off by 0.5%, and the NASDAQ down by 0.5% as well.
Yeah, Walmart shares are on track for their lowest since November 2023, and that's really been seen as a bellwether, especially when we think about the state of the consumer. There's a lot of concerns right now when we think about inflation, the impact of tariffs. We saw a disappointing retail sales number for the month of January that was ultimately chalked up to seasonality, but still the softer guidance there really spooking investors.
Yeah, and raising concerns about how the consumers are going to be reacting to a lot of the headline noise right now out of Washington regarding tariffs. And speaking of tariffs, Walmart also talking about how it plans to manage through tariffs as it has in the past, but there are still some questions about that. And you can see broadly in retail, we've got declines. Amazon is down, Costco is down, Target down 2% as well. And if we look at the sectors that are on the move today, Walmart in consumer staples, which shows up right here. And then we also have financials that are doing poorly, perhaps because they've been running lately and perhaps in part because of that broader concern about the consumer.
Yeah, Wall Street has been very bullish on financials. There's not quite a clear catalyst for why financials are down today. I mean, year to date, we're still in the green pretty much for all of the sectors except for consumer discretionary year to date. That's the only sector that is in the red here. But financials, we've seen record highs for a lot of those big banks recently, like JP Morgan, Goldman Sachs. Perhaps there's some concern about the economy. Again, policy uncertainties has really been weighing on a lot of these names.
Yeah, I mean, this is one of the best performing groups year to date. So the sell-off coming kind of on the back of that. So sort of put that in context here. Well, stocks are pulling back with the S&P 500 retreating from records as Walmart's dim outlook spooks investors over the earnings picture for stocks. With markets also still assessing the impact of President Trump's planned tariffs and policy shifts, we're taking a look at the investing landscape with Mark Newton, Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy. And Mark, in a note yesterday, you were talking, even as the S&P 500 was up there at a record, you said we could see some consolidation here. So it looks like we're seeing that consolidation today. What happens now?
Well, a lot of it depends on your time frame. I mean, in the near term, you could see 3 to 5 days of consolidation. I don't really think we're going to see a whole lot of selling happen right now, specifically because sentiment is actually so guarded and bearish. People have become distracted with a lot of the tariff talk and the potential rise in inflation. And, we see polls like NAAIM, the name survey for institutions, the active institutional managers that has pulled way back in recent months from over 100 down to near 75. AAII is a retail poll, still shows about 11 percentage points more in bears than bulls. So with a market that just hit new all-time highs yesterday, when you look at the S&P and QQQ, I think that's really, really interesting. It's one of the few years where we've come into the year, and yes, it's been a choppy year. However, sentiment has been pretty pessimistic at a time when indices are near all-time highs. So I actually think that's very encouraging for investors.
And Mark, your fund strat partner, Tom Lee, he had a note about how you should never short a quote unquote dull market. So can you explain what makes this current market dull and how that could maybe actually be a good thing for investors?
Well, the market's been largely choppy and almost unchanged for the last 2 months. And so we did see initial all-time highs happen into, November. But despite the S&P and the Qs, and we see equal-weighted S&P, the Dow, the Russell, the Dow Jones Transports, the NASDAQ Composite, none of those are at new all-time highs. So many of those have lagged and are showing divergence. Oftentimes that means that we need to see sort of a catalyst to see this broad-based rally really start to materialize, and I don't think we're quite there yet. However, we have seen a pretty decent downward trend in interest rates on the long end, as well as the US dollar, and both of those are very conducive towards risk assets and thinking that we can push higher. It's almost exactly the opposite of what everybody's saying, that the new administration is going to cause rates to scream higher with the yields above 5%, the dollar is going to go up. Well, all of those things happened last year. Now we're seeing exactly the opposite. And so it might be something just to consider that, there are some things that offset the inflationary impacts of tariffs, meaning higher crude production by 3 million barrels a day, along with OPEC Plus turning on the spigots. That's going to cause crude to likely fall to 50 or below. And, I also think that China's weak recovery, we've seen a pretty fragile rebound thus far. The equity market's rebounded, but the real estate market certainly hasn't. So China has a very big potential to export deflation to the rest of the world that would certainly offset a lot of those concerns. And we can't see used car prices and insurance continue to rise at the same levels we have in recent months. And so I take the other side of inflation's going higher. I think yields are on the precipice of a large decline in the next 4 to 6 months, which means, the 10-year can get down, not only down to 4.10, but likely crack that 4% level. And so that's going to be very encouraging for a move back into growth, into technology, and to think that the market can do just fine.
What about all the spending that this administration, perhaps in its next phase is going to be pushing for, whether it's tax cuts or some of its other fiscal measures? Does that mean that, that 10-year at 4%, that its days would be numbered at that kind of level?
Look, spending has been a big problem over the last, arguably, 7, 8 years. And I think that's definitely something we have to come to terms with at some point. There's no easy answer on how to really rein that in. I think we're all hopeful that we can see, progress potentially with what DOGE is doing. But honestly, that's a first step. Those aren't things that immediately affect the stock market per se in the short run, but certainly are very legitimate concerns about what's going to happen with spending. Extending the tax cuts are thought by some to, okay, that's going to be a big increase in money that comes in. However, it's also a very big negative in a lot of ways if we allow that to expire. So we want GDP to be higher, we want people's taxes in general to be lower so that companies can hire and it leads to job creation. So there's a lot of you can choose either side you want, but overall, the spending is a big deal with the deficit now at, $37 trillion and interest on debt having to be refinanced at rates that are much higher than they were 2 years ago.
So over the long term, you're bullish on tech. You alluded to that move back into growth. But in the short term, especially year to date, we haven't seen tech outperformance as we've been used to, especially when you think about those Magnificent Seven names. Nvidia earnings are coming up. If Nvidia is not the top driver within this stock market, at least right now, what sectors and what companies are you looking towards?
Well, I do think the Magnificent Seven has turned from the Mag 7 into the Lag 7, over the last couple of months. However, I don't expect that to last too long. I do suspect that most of these tech stocks are going to start to reignite and push higher. We started to see that with Microsoft just a couple of days ago. Microsoft's been in a range almost for about a full year. And so it hasn't been the stocks like Microsoft which have led. It's really been the Meta platforms, the push into software, at a time when semiconductors have been lagging. So we've seen that move into Palantir, of course. And yes, the last few days, we've seen a lot of stocks start to sell off sharply for reasons that maybe the fundamentals don't justify. And so technically, many of those should be buying opportunities. But when you say what's been working, a lot of it's been the banks, not only here, but also in Europe. It's been the primary driving factor of really why a lot of European indices have managed to outperform U.S. stocks so far this year. It's been a falling euro, and it's been really financials being in a very good spot to a lot of these banks that are outperforming. And so that's happened not only in Europe, but also here, stocks like JP Morgan, Berkshire Hathaway, and the like. So I'm actually very encouraged by the financials. Industrials also have outperformed, and people thought this sector would get hit hard on tariffs, but we've seen stocks like Deere and Caterpillar, some of these machinery names that have a lot of asset revenues coming from overseas. They've actually managed to thrive during this whole time. So I think there's a lot to be happy about, and I think investors really need to ignore a lot of the exogenous events until they start to affect the stock market. And the stock market right now looks like it's operating, with a lot of things that are working that need to be working. That meaning technology coming back, the best performing sector in the last week almost. Financials, industrials, discretionary. We're finally seeing the consumer return to the market after last year, which it was absent. So, I'm optimistic at a time when sentiment is very guarded, to say the least.
I want to ask you specifically about Nvidia for a minute here, Mark, because we're going to be getting the earnings from the company next Wednesday after the close. We were crunching the numbers here today at Yahoo Finance and found that, Nvidia accounted alone for 20% of the S&P 500's gain last year. This year, it's only 5% thus far, and it's been underperforming the market. Is Nvidia still that big, broad market catalyst that it was at one point?
I certainly think so. That when you look at the market capitalization and how much Nvidia commands of the S&P and also QQQ, and so to your point, it has lagged a bit in recent months. It's been more sideways. Still, stocks like Nvidia, along with Taiwan Semi and Avago, those are some of the top stocks within the entire semiconductor space. But you only have about 3 of the top 10 outperformers within the S&P that come from the Magnificent Seven. It's been pretty broad-based and spread amongst many different sectors. You have many of the financials. You have Walmart participating and showing great gains. So I do think Nvidia is important. We heard from the conference calls of the Metas and the Amazons and the Alphabet how much they all reference Nvidia in their conference calls, saying that yes, you're doing lots of capital spending and a lot of money is going into Nvidia. So there's continuing to be very high demand. I think that it's going to outpace supply. I don't think this company and this stock is going away anytime soon. So I like Nvidia. I don't care to guess as to what earnings will be, but honestly, the stock has had a very decent rebound in recent weeks at a time when many had given up on it based on DeepSeek, and now it's really started to show much better strength. And for me, as a technician, that's encouraging.
Well, we'll see if indeed earnings prove to be a further catalyst. Mark, good to see you. Thank you.
Likewise. Great seeing you both. Thank you.
We're just getting started here on Market Domination. Coming up, we'll get you caught up on some of today's top trending tickers as shares of cruise liners in particular in focus. Plus, President Trump's ongoing trade wars have thrown a wrench into a variety of industries, including autos. We'll be watching that, potential impacts. And we'll be right back. Now time for some of today's trending tickers. Let's start with Unity Software. Those shares rocketing higher today. The video game development software company posting surprising fourth quarter results. The company's revenue of $457 million, beating Wall Street estimates of $432.5 million. The stock has dropped about 25% year over year. It also, by the way, announced it's migrating its ad network into the new AI-powered platform Vector. That's in an effort to keep pace with market leader AppLovin. And the company actually came out with forecasts that weren't great. So the stock went down, but then it went up.
Yeah, and that's interesting because you normally don't see that in this beat and raise environment. Typically, investors, they want to see that guidance come in ahead of estimates. That being said, though, we did receive some analyst commentary. Citi writing in a note after their report that it looked pretty solid despite that disappointing forecast. Benchmark also raised its rating on the stock to hold from sell. So it really seems like the turnaround story, the future of this company, that's what these investors and analysts seem to be hanging their hat on. Across Wall Street, we have 15 buys, 14 holds, and now after that benchmark raise, just 1 sell.
Yeah, exactly.
not too bad.
So it looks like people are relatively bullish on this one.
All right, well, next up, Bond. James Bond will now be under the creative control of Jeff Bezos. See what I did there, Julie? In a newly announced press release on Thursday, Amazon MGM Studios will assume control of the franchise from the Broccoli family, which have been responsible for producing the Bond films for more than 60 years. Minutes after the news broke, Amazon founder Jeff Bezos took to X to ask fans, who would you pick as the next Bond? Amazon bought MGM in 2022 for $8.25 billion, acquiring the studio's catalog of 4,000 movies and 17,000 plus TV shows. As part of the deal, Amazon gained possession of the rights to distribute all 27 of the Bond films. And that's really key here. They had the distribution rights, but they did not have the creative control. So they weren't able to, determine when the movies could go into production. They weren't able to select the cast. And this is a big turning point because now they can, hence why Jeff Bezos is now asking the public, who should be the next Bond?
What do you think?
Okay, I've been thinking about this.
Wasn't Idris Elba supposed to be Bond at one point?
He was rumored, and then it seemed like he wasn't.
Right.
I love Jonathan Bailey. I mean, I know he's not the obvious choice. He was just in Wicked. He is a little, but then you think of, Tom Holland and Spider-Man did really well. Maybe
yeah,
you
but
could
I
take
feel
a
like
different
Spider-Man
direction.
makes sense as a shorter guy. I don't know if Bond, although it's not like Daniel Craig is some hugely tall
I feel
person.
like we need a deviation from Daniel Craig because he did such a good job in that role, and then now that he's done, I wonder what that means for the future of the franchise.
Well, Idris Elba would be,
All right, well, all right, that's Julie's pick. He might still be in the running there. Moving on to some cruise lines. Shares of cruise liners, Royal Caribbean, Carnival Corporation, and Norwegian all moving lower today after newly confirmed Commerce Secretary Howard Lutnick suggested those companies would have to begin paying U.S. taxes. Lutnick saying in an interview that the ships of cruise line operators fly under the flags of various countries, not the U.S., and therefore they don't pay U.S. taxes. For more on this story, James Hardiman, Citi leisure and travel analyst, joins us now. And James, you said that the likelihood of cruise operators becoming full taxpayers remains, quote, exceedingly low. So is this all just more political noise in your view, and investors, they're maybe overreacting here?
Well, look, I think that in all likelihood, this is an overreaction today. But I don't want to underestimate what I think the big risk is here, which is just headline risk, right? This is an industry that had been exempt from a lot of the turmoil surrounding tariffs and some of the other policies of President Trump, and now they find themselves right in the crosshairs of the president, which is exactly where you don't want to be. I also think there's a lot of room between where they currently are, which is not paying any federal income taxes, and being a full taxpayer. So it doesn't mean that zero is the right number long term, but I think it's exceedingly unlikely that they would go from zero to being a full taxpayer.
Well, and James, for those of us who are not familiar with the tax structure of these cruise lines, how exactly does it work? Do they pay, depending on, where are they domiciled? Are they paying taxes depending on where the ships are, which flag they're flying under? How does it all work?
Yeah, so let's take a step back. For the purposes of the U.S. tax code, the cruise industry are, they're essentially foreign shipping companies, and they're therefore exempt from federal income taxes. So they're incorporated, right, in other countries, Panama, the Bahamas, Liberia, Switzerland, although they're headquartered in the United States, right? And so I guess if you wanted to tax them, you could either say that companies headquartered here in the United States would need to pay taxes, in which case you would risk them moving their headquarters, right? And there would be significant job losses, particularly in Florida, but also, California, Alaska, even New York. I guess the other way you could do it is that you could say that the time spent in U.S. ports is going to be taxed, and it would need to be taxed at a high rate because at the end of the day, they don't spend a whole lot of time at U.S. ports, right? They spend most of their time either in international waters or at, the ports of other countries. So it's not an easy fix here, even if you determine that these are companies that are avoiding the U.S. tax code. But, I think the fact of the matter is they were set up a long time ago for this specific purpose, right? So that they wouldn't need to pay U.S. taxes.
Now, this tax-exempt status has been challenged in the past. Nothing has happened. So what can you look back on in history to sort of give us a guide about what we could potentially see from this?
Yeah, I mean, look, if history is any indication, this is much ado about nothing, right? This has come up at least a dozen times in the past, and it's difficult to tax the cruise industry without taxing the entire shipping industry, right? Which falls under the same tax code. There would obviously be major issues with that if we're concerned about inflation. What's going to happen if we slap a meaningful tax on all, cargo containers that are coming to the United States? I guess the only pause, right, is that, Donald Trump, the Trump administration, it's a different animal, right? And so these threats are generally to be taken seriously. And again, at a very minimum, I think these cruise companies don't want to be in the news. They don't want to be forced to talk about what is a pretty favorable tax situation.
Right. They want to be in the news for their, big new wonderful ships or whatever it is. And also for their earnings, because by the way, we're looking at this sharp sell-off in these stocks today, but they've pretty much all done very well over the past year and have been outperforming the market by pretty wide margins. So I'm just curious, also taking a step back, whether you think, sort of this aside, these companies have more room for upside.
This aside, I think they definitely have more room for upside. And this included, I actually think this is a buying opportunity, right? One of the things we've always said about the cruise industry is, there's a lot that can go wrong. There's a lot of headline risk, whether it be, fuel prices, geopolitics, any number of issues. But they tend to recover stronger after those major events. And so this could be the makings of, I think, a pretty good buying opportunity. But you're right. The cruise industry is absolutely having a moment. I think what cruise travel represents today is a better product than they've ever brought to the table. And so, I don't think this is just some, post-pandemic trade where they're just playing catch up, because if you remember, they were out of commission for much of the pandemic. I think this is more than that. I think it's a better product, and I think this trade has some legs.
You mentioned some of those potential risks, like higher fuel prices. We've also seen lower bookings in California due to the wildfires, in Canada also due to the strong U.S. dollar. What other risks are you looking at? Because yes, even though we've seen this huge post-pandemic boom, there are still some uncertainties out there. Sure. I mean,
the biggest risks, I think, with the cruise industry is often, as we think about the geopolitical realm, right? Whether it's for a period of time there was terrorism in parts of the world, parts of the Med were sort of taken offline. As we think about the last couple of years, 2 wars happening in the world. Anything that takes significant chunks of the map off the board, right? Capacity is effectively fixed. And so if you take away some of that potential demand, right, you get an imbalance, and you tend to see it in pricing. Having said all of that, the last couple of years have been, far from clean when it comes to those offsetting events. And yet the cruise industry has continued to put up some really impressive numbers.
All right, James Hardiman, thank you so much for your insights. Appreciate it.
Thank you.
Coming up, data from the Conference Board showing some interesting results when it comes to what CEOs think of returning to office. We'll get you the numbers on the other side. Stick around, much more market domination still to come.
Time now for our call of the day. North Coast Research downgrading Axon Enterprise from buy to neutral. The note citing concerns that investors will be let down by next week's earnings report. And by the way, the stock just closed at a record. It's more than doubled over the past year. This is the maker of tasers. They also make the body cams. And this downgrade seems to have a lot to do with valuation.
Yeah, lofty valuations. We have earnings next week. Like you said, Julie, always a risk investors could be let down. The analyst also cited some competition that could potentially hinder the company company's growth trajectory. And we know that valuation, that's been a big concern, especially within this frothy, concentrated market. So always something to look at. But as you mentioned, the stock is just absolutely ripped.
Yeah.
It's up 100% over a 1 year period. Over the past 5 years, up over 500%, trading at a PE ratio very higher than Nvidia even. So that just goes to put some things in perspective. And, all that being said, on the street, 15 buys, 1 hold at now due to that downgrade, and 0 sells. So it seems like there's still some optimism there.
Yeah, we'll see what happens with the earnings.
Yes, definitely. Always something to keep in mind with the earnings. Moving on, CEOs are feeling as confident as they have ever over the last few years. Joining us now for more is Yahoo Finance markets reporter Josh Schaefer. So Josh, the conference board out with this data this morning. What did it show us?
Yeah, Ali. So CEO confidence overall hitting a 3-year high, coming above 50 here, shooting up to 60 in the first quarter of 2025. That again, that's the highest level we've seen in 3 years, and that marks a shift among CEOs that were before cautiously optimistic to now confidently optimistic. They feel better about the overall economic outlook right now and the economic outlook coming in the next 6 months. Pretty good picture if you are, of course, an employee, for your employer to feel good about the economic outlook and not be looking to cut jobs. Does come with a catch, though. If you are a remote employee, you might not like to see this chart. So CEOs saying that they're looking to move more workers into office. So in green here, we have the current worker arrangement. 19% of CEOs said that they have 100% in office. They expect that to move to 26% of CEOs seeing 100% in office. Then also you look at office in 3 to 4 days per week. That's going to move from 67% to 71%. So of course, guys, we know JP Morgan CEO Jamie Dimon recently coming out talking about moving workers back into the office. He feels like it's time to end Zoom. It feels like Mr. Dimon might not be alone here, and the RTO switch and that shift to employees continuing to come back into office feels like something that's here to stay.
Josh, thanks. Appreciate it. Well, applications for unemployment benefits slightly rising from the previous week's revised level. Jobless claims hovering around pre-COVID levels, indicating solid demand for workers. However, we need to look underneath the surface. For a closer look at the layers of the labor market, we've got ADP Chief Economist Nela Richardson. Nela, it's always fantastic to see you and to get your perspective on these matters because you do have that deep understanding of what's happening under the surface of the labor market. So I'm curious what you're seeing. I know you guys have been doing a lot of survey work. What have you been turning up?
Hi, good to see you, Julie. Well, overall, if you look at ADP payroll data, we're still seeing a very solid market. And even though initial jobless claims can move quickly back and forth from week to week, they're still at 2-year lows. So there's strength there. But underneath the hood, as you mentioned, there is pockets of weakness, manufacturing being one. But what's really interesting is when we turn to our worker sentiment survey, which shows that in the U.S., around 2/3 of U.S. workers feel like they're living paycheck to paycheck. So even though we've seen enormous pay growth over the last 4 years coming out of the pandemic, people are still feeling the pinch of inflation. And that is leading to different ways of providing labor, like getting a second job, for example.
There's a lot we look at when it comes to labor market, whether we think about the unemployment rate, jobless claims, wage growth. Is there a particular metric that you're focused on when we think about some of these cracks?
Yeah, it's a great question. I think my center of gravity is pay. It's payroll, because that is really where the labor market finds its equilibrium. That is the balance between employers' demand for workers and workers' supply of labor. And you can see how that varies across industries, how it varies across demographics, but importantly, how it connects to inflation. What economists are always the most worried about when it comes to the labor market and inflation is that wages would spiral out of control and trigger inflation. We're not seeing that yet. We haven't seen it, actually. Wages have fallen a lot in terms of growth from the peak pandemic growth rates that they had coming out of it, but they're still elevated. And so in my view, it's why inflation hasn't gone back to more comfortable levels quite yet.
Nela, while we have you, I have to get your take on Doge and what's happening with government employment, but not even just direct government employment, government contractors as well, right? And, this sort of ripple effect, what's happening in D.C. What should we be looking for in terms of the labor market indicators to see where that's being felt?
I think, Julie, the first place to look would be those initial jobless claims that won't get all the difference in workers who are applying to claims, which is a proxy for layoffs that many economists use in the area, and not just the DC metro area. That federal workers and federal contractors are nationwide. So looking at those claims data is important, as we did today. Also looking in the private sector, seeing if maybe workers are staying put, they're seeing more competition in the labor market, how the private sector responds to what's going on the federal side will be interesting to watch over time. Too early to see that yet, but something I'll be paying attention to.
What about immigration? That's something that I feel like has been maybe a little underreported as tariffs have dominated the conversation. What impact do you think immigration policies could have on the labor side? Is that a concern to you at this point?
Well, if you look at government statistics, the U.S. labor force and employment is supposed to increase at a fraction over the next decade that it did over the previous decade. So like 0.4% annually compared to an annual rate of 1.3% in the previous decade. So employment growth is slowing because a lot of workers are retiring. And so the question is, how do you keep up with consumption and growth? One of those ways is through immigration. Now, it's interesting to me also in this time of hybrid, despite some of the CEO sentiments on hybrid versus remote versus in-office work, one thing that remote and flexible work options do is widen the pool of workers that an industry and a company has access to. And that can be borderless depending on the company. So I think all of this is still in flux. Immigration historically has been really important to sectors like construction, for example. So how the labor market evolves from here will have to take into account the fact that the working age population is aging and we'll need some workers in key industries.
Well, and not only will it affect sort of supply and demand, but it'll, going back to the idea of wages also, couldn't we see some sort of knock-on effects from the immigration picture on wages as well?
Whenever there are shortages, especially like in high demand sectors like construction, like agriculture, you'll see wages adjust. And that's why it is my primary indicator of the labor market, because it reflects this worker supply issue that will be vital to us as the demographics of the country change.
And when you think about the Federal Reserve, we've been talking a lot about inflation and inflation likely to remain elevated over the long term. How much more pressure does that put on the employment picture for the Fed?
Well, right now, the labor market is playing along. It's allowing the Fed to be cautious, to be patient. You saw that the unemployment rate went down to 4%. And so, yes, particular people are always part of the rule outside of what that unemployment rate shows. And there are people who are taking longer to find jobs in this economy. However, the unemployment rate at 4% means that the Fed doesn't have to move quickly, that it can incorporate policy change into its decisions. And I think that's what we're seeing right now.
Nela, good to see you. Thank you so much. Looking forward to more jobs data and more analysis from you. Appreciate it.
Thank you.
Coming up, shares of Palantir sinking today on a report of potential defense budget cut, as well as comments from the company's CEO, Alex Karp. We'll be joined by an analyst on the other side to get you caught up on the latest and what to do with the stock. Stick around, much more market domination still to come.
AI bulls saw a pullback when the world was fully introduced to artificial intelligence upstart DeepSeek, and our next guest believes it may have started a rotation within the sector. For more, let's welcome in Ellen Hazen, FL Putnam Investment Management Chief Market Strategist and Portfolio Manager. So Ellen, let's start there. You believe we're in this rotation away from hardware vendors towards software vendors. What are the implications of that at this stage of the AI trade?
That's a great question, and that's exactly what we're seeing. we've all seen the DeepSeek news that came out a few weeks ago at this point, where it looks as though the cost of using AI is much lower than what we thought just a month or two ago. What does that mean? Well, it means that the companies that are deploying AI are going to be able to build models much more cheaply. They're going to be able to roll this out to their customer base much more cheaply. The whole question about, oh, well, are you ever going to get an ROI on this model? Well, that's an easier question to answer if if the cost of building the model is much lower. So just as we saw with the internet rollout back in the late 90s, early 2000s, initially the play was hardware. Remember JDS Uniphase, Cisco, and so forth. But then what happened afterward? It was the companies that were using that as a platform, the companies that built on top of that and offered products directly to other businesses and consumers that ended up being the real winners there. Companies like Facebook, companies like Amazon. And you're going to see the same thing here. So you're going to see the software companies and the hyperscalers accrue more of the AI value than we thought a month or two ago before we realized that the cost of AI was coming down so quickly.
You know, it's interesting because the defenders of some of those hardware companies will say, well, if it's cheaper, that means they could do more volume, right? They can just sell more of the stuff if it's at a lower cost. I'm curious what you think about that take.
I think we all learned in Economics 101 that the demand curve is downward sloping, and the more expensive something is, the lower demand is, and so forth. Or I guess this the other way around. And so therefore, it is true that if something is cheaper, you are going to use more of it, right? No question. The question is, if it is 20% cheaper, are you going to use 20% more, right? If it's half as cheap or half the cost, are you going to use twice as much? And we don't know what that elasticity of demand is going to be. I do think when you have a dramatic price decline, what you're likely to see is definitely an increase in uptake, but more volatility. And so it's not going to be clear for a while whether or not the increased uptake is large enough to offset the fact that it's going to be cheaper per. I don't think it's necessarily a straight line, but I do think that we have proven, think about it, right? With things like memory, the amount of memory on your phone, the CPU power on your phone, the amount of storage for your camera, and so forth. Every time we get cheaper storage or cheaper CPU cycles or cheaper capability, we find a way to use it. So I don't think that's a question. I think it's just a question of timing. How quickly will that happen? And will there be an air pocket in the middle somewhere?
Ellen, is this a rotation that would have happened regardless and DeepSeek just accelerated that timeline? Or did DeepSeek represent this fundamental moment where the narrative just completely changed?
I think that the cost was always going to go down, just as electronics costs have gone down for generations. So that was always going to happen. I think the narrative that changed was really more in the stock market than in the underlying technology. So I think that there were investors who believed that Nvidia and other stocks like that were going to be able to maintain pricing power and have very high volume growth indefinitely. And that narrative has shifted. But I think for practitioners, for people in the industry, they knew it was going to come down. Did it come down more suddenly? Perhaps, but I don't think it's a fundamental change in the narrative.
So, Ellen, all of this said, are you guys redeploying in this direction that you're talking about, sort of away from hardware and more into software, or are there other areas of the market that you think are even more attractive right now?
We're doing both. We are definitely taking some of the gains off the table in the hardware space and redeploying that into some software names like Salesforce, like ServiceNow, and others. But at the same time, we're also looking beyond the Magnificent Seven to more of the other 493 names. So we're looking at some healthcare companies like Stryker, Artificial Knees and Hips. We're looking at some industrial companies like AECOM, which does power infrastructure, and we're looking at other companies across other areas in financials and across the board outside of just technology.
Are there any trades maybe in the software sector that you should avoid at this point, or maybe take a more wait and see approach, since we've seen how quickly stocks and the market reacts to a lot of these headlines?
I think on the software front, you always need to be careful about not overpaying for growth. Most software stocks that are worth owning are going to be expensive, and so you do need to pay up a little bit for them. But because the multiples are so high, that means that if you see a hiccup in fundamentals, then the stock is more likely to have a dramatic downturn. And so you want to look at a couple things. Number one, you want to look at the free cash flow conversion and make sure that they're turning their earnings into free cash flow. And number two, you want to look at the earnings multiple compared to its own history. And if it's expensive, but it has always traded at that kind of multiple, that's one thing. But for a stock that used to trade at 30 times and now it's at 60 times, I think that's where you might run into trouble. Finally, the last thing we really focus on are earnings revisions. As long as earnings revisions are going up, you might be able to hold a rich multiple. But if earnings revisions start to be negative, then you're going to be in trouble when you have that high starting valuation in the software space.
Ellen, good to see you. Thanks for joining us.
Thanks.
Shares of Palantir are falling today after reports that CEO Alex Karp has a new trading plan that provides for the sale of up to $1.2 billion of shares. In addition to that, of course, we've been hearing some talk of cuts to defense spending. For more on all of this, we're bringing in Louis DePalma, research analyst for industrials at William Blair. Louis, it's good to see you. Obviously,
Great to see you too.
Palantir's sort of a controversial stock, right? People have been complaining sort of about the valuation there. Then you get this report that Pete Hegseth wants the Defense Department to draw up a plan for cuts. What does all of this mean for Palantir?
Yes, first of all, thanks for having me on the show. I've been a big fan of Yahoo Finance since I was in college at Providence College many years ago. But
amazing. Thank you.
For your question, what does, the Department of Defense budget and Pete Hegseth and Doge mean for Palantir? It relates to how approximately 55% of Palantir's revenue is derived from government customers, and the majority of that government revenue comes from the U.S. government. There are also international government customers, but then within the U.S. government revenue, the vast majority comes from the U.S. Army specifically. Now, with Trump 2.0 and the new regime, generally speaking, there's a perception amongst investors, and some of this has been voiced by the new administration, that there's going to be a shift towards the U.S. Navy and the Air Force. And, while Palantir does do work for those customers, it's a much lower percentage of their total government base. And so there are questions about whether some of, Palantir's new initiatives with the Army, may proceed, at the current pace. For instance, one of Palantir's big contracts is called Project Titan, in which they are providing trucks that are equipped with an array of sensors for the purposes of targeting. And this program is expected to cost between $1 billion and $1.5 billion over a 5-year period. And so there are questions such that, in the new Trump regime, is this program going to start on time? And is there going to be adequate funding, if there are shifting priorities towards, the Air Force, the Navy, the Marine Corps, et cetera? So there are many moving parts here. As you said, it's a controversial stock.
And Louis, we've been hearing a lot of quote unquote noise from this administration. Even if you think about something like tariffs, the only duties that have been implemented is that 10% levy on China. Everything else is sort of up in the air at this point. So do you think this could be just more noise?
Yeah, so last night, several media outlets reported that the new administration is looking for 8% budget cuts. But other media publications indicated that there aren't going to be budget cuts. There's just going to be a shifting in priorities. And so $50 billion that may have gone to one bucket of programs will be shifted towards drones, missile defense, such as the Iron Dome initiative, counter drones, cybersecurity, the Virginia class program with General Dynamics Electric Boat was highlighted. The Collaborative Combative Aircraft program, that was highlighted. And so, that could favor, vendors such as Kratos, Anduril, and a bunch of others. So there's just expected to be, a shifting of priorities. Last week, Secretary of Defense Hegseth indicated that the Trump administration wants to outspend the Biden administration in terms of defense. And there were members of the Senate Armed Services Committee that wants to actually increase the defense budget by over $100 billion. And so there seems to be, strong support to continue increasing the defense budget.
Right.
But, headlines right now are driving a lot of the market moves.
Well, so Louis, all of this said, you have an underperform on Palantir specifically, right? But it doesn't sound like you're bearish on the defense spending piece of it. Is it a valuation call, or why do you think people shouldn't come in here and buy Palantir?
Yes, I would point to how from the time period of 2021 through December of 2023, Palantir shares went down by 82%. And during that time period, Palantir's government revenue, it grew at 77% in 2020, and then it decelerated all the way until it hit, a bottom at 10%. And, we feel that Palantir's, revenue growth on both the commercial side and the defense side, may repeat its history and, decelerate from these current elevated levels. And, when or if that deceleration happens, the valuation support for Palantir, could be, 60 or 70% lower than where it is today. And so, we would prefer, other names over Palantir.
Gotcha.
Louis, thank you so much for your insights. Appreciate it.
Yes, thanks for having me on.
Well, while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all of the action following the closing bell. Stay tuned for Market Domination Overtime. That's next.